Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table.
All right, well, welcome back to another episode of Integrated Insights. Today I've got Dave and Grant back with us talking part two of real estate and transactions and just other considerations to have. So started off with what are the potential challenges when transferring lease agreements during a business transaction?
Oh, for they are many. They can be. I mean, they don't have to be, but oftentimes there's not. And oftentimes it's dictated by the lease that's already in place. So there's an assignment that's got to happen. And typically we found that most landlords are pretty good about having a process in place to transfer that lease. Interestingly, we just closed a deal that had 3 different locations involved with it. And 2 of them were leased by the owners of the business. They were all the same owners of the businesses. They leased 2 of the properties, and they own one of the properties, so that made it really interesting too. And on the property that they owned, that lease needed to be redone because there wasn't much time left on it. So they wanted to extend it. And so that ended up being something that was a really interesting part of the negotiation, because we were trying to there was this tension between doing a lease that was advantageous for our client, but they were really wanting to make sure that the lease was written well so that they could then sell the property in the future. And the value of a property in a really high real estate market, or high value real estate market, has everything to do with how the lease is written, because the banks are going to loan on how that lease is written in the future. And so, we try to be cooperative with that, while at the same time we don't want to make our client have to pay more than they're supposed to pay, or make sure the options and everything. So, we on the other one that was really interesting on that and really affected the property was we were held hostage a little bit by the landlord. Not that we had great conversations, but they really held the power, because that lease was like 1 month from being done and there were no more options. We basically had to go in and negotiate a new lease, and the market rate that they'd come up with was really too high for our client it just didn't make sense. It didn't pencil with the kind of business this is. And so it was a really interesting discussion. Fortunately, we were able to prove to them that their comps really weren't applicable to this particular business. And so we were able to go in and actually do a pretty decent rent increase over time. And then also we were able to lengthen the lease and then add a couple of options on it as well. So that ended up being a pretty good deal for the client. So
a lot of time that I've seen you do this, Dave, when you are negotiating, because you end up being neck deep in that part of the woods, and you come across this where also the guarantor of the lease is changing. In other words, in that particular business, a medical business, and so there was doctors that were guaranteeing the lease. And now all of a sudden we have a corporate owner that is going in there and he doesn't want to personally guarantee anything. And so, how do you negotiate that? And so the guarantor piece, as well as the term of the lease, sometimes lands us in a position where a whole new lease is negotiated rather than the old one is assumed. And whenever that happens, you have to be careful, because the rental rate is then renegotiated, and it might cost the valuation on the business as well.
yeah, that's a good point. Yeah, it's a great point.
So how can lease agreements be structured to protect the interest of the property owner?
I mean, a triple net lease is probably the most common we see. And basically what that means is there's a base rent, and then there's another piece to that rent that pays all the taxes, insurance, upkeep, maintenance. And the landlord never has to really touch the property unless there's something catastrophic that happens or something that they're responsible for. But in most cases, the tenant is responsible for for everything. So that is, that protects the property owner, a lot. And so if we were representing a seller who was wanting to keep the property, we would want to make sure that we would hope that we would want to make sure that they have a triple net lease. And oftentimes the real estate broker that maybe has been dealing with this brought back in to negotiate that part. Sometimes we don't have to really negotiate that. We kind of get them to do that. If we're representing the buy side, we tend to get involved in the negotiations a little bit more.
Yeah, because it affects the valuation of the business for sure. We get involved with it, and I think the other side to it is that the times when Dave and I have owned our own businesses and have owned the real estate in a different entity, you'll find those leases are not arm's length. They're just to satisfy the bank when you finance the purchase, because it's not like you're going to sue yourself for rent, right? And so the lease is not tight at all. It's very it's very loose. And when you are now going to lease, you're going to keep the property as a seller, and now you're going to lease it to a new buyer. You want to make that lease very tight. And so you're not going to let that buyer assume that loose lease. You're going to want your lawyer to draw up a lease that protects you and make sure that it holds them accountable to do their part of the lease.
Yeah, that's good. You guys have kind of touched on this, but how do existing lease agreements affect the sale or the acquisition of a business?
Well, I mean, it's part of your expenses, so it's going to be part of your cash flow analysis, and ultimately, you're looking forward. So let's say you're getting ready to have to take a next option. You're not only looking at, and just say you're paying 4 times multiple on EBITDA. Well, you're going to need to kind of take that into consideration, look forward, and go, well, in 2 years the rent's going to be X, and maybe they've got a pretty good, or maybe it's not determined. Maybe it's one of these, at market rate, which I always find that extremely scary in leases. That really holds. I mean, it's a great thing for the landlord to put in, but it's really not all that great for the tenants. We always try to define that, whether it's a 2 or 3% escalation annually, which we see all the time. That's not unreasonable, but it's, so those things just have to be really dug into. You dig into those things during due diligence and figure out, and you may have to adjust the price if all of a sudden you realize, next year our lease is going to be, $20,000 more for the year. Then you would adjust, in most cases, we would adjust that multiple a little bit or adjust the EBITDA number.
Mason, there's a business that you and I have just dealt with that, the fair market value rental, the fair rental rate of that real estate is way too much for the business to endure. You see these plays where years ago, Dave and I looked at a business that was an RV storage and repair place. It was massive real estate right off of the highway in Plano, Texas, and the real estate was worth, $20 million, but the business wasn't making very much. And so they were trying to sell the business and the real estate, but the business was just not able to support what would be fair rental on a very prized piece of property like that. And so it's almost impossible to finance. And so, you see that on a very much smaller scale in the business that we just dealt with, where the seller has asked a real estate agent, okay, how much is the fair rental rate? And they came up with a $20,000 a month rent. Well, the business is not used to paying that. The business is used to paying $5,000 a month in rent, and the seller doesn't want to change the sales price. And so you have to be very careful in considering the lease and what you're asking for as a seller, for sure, because it will affect whether the business needs to stay. And I would just tell you, it's our experience that some businesses need to stay on that particular real estate. It is key that exposure. Maybe it's in the middle of the of the highway system, so it's easy to get everywhere. Maybe it's strategic in the way that it's equipped. A lot
Maybe
of
it's zoned a certain way.
Yeah. And so it just, sometimes real estate is super important. And so a buyer may want to secure that either with a longer term lease or a purchase of that property. But it's super difficult to kind of get your arms around how important that real estate may be to the buyer. So when we represent a seller, we're looking at it holistically. What happens if we were the buyer? What would we want from a real estate standpoint, from a lease standpoint, from a term standpoint, all that kind of thing, because it can change the business. Some businesses you can move it any way you want, and it's no big deal. We interviewed another business owner the other day, and he said, "Hey, I'm taking $12,000 a month in rent, but anybody can just move this business to some place that charges $2,500. Okay. If it doesn't matter where the business is, then you can do that.
Yeah. Yeah. That's really good.
Did he not care whether the business went with the sale?
No. Because the fair rental value was way north of what he knew that was fair for the business to pay. And so he said, well, let them go and I'll either rent it to somebody else or I'm going to sell the real estate. So this is, maybe this brings up a soapbox just real quick. A lot of these guys will go to an investment guy who is unfortunately incentivized based on the amount of money they invest. And I would just tell you that Dave and I, obviously we like to invest through investment advisors, but we also like to have real estate. But our investment advisor is not paid to invest money in real estate. And so the advice that they're getting is sell all your assets, give us your money, we'll invest it, and you can retire. Well, sometimes it's not the greatest advice. You need to keep real estate and invest some of the proceeds in the market. And so getting a more rounded perspective on that is super helpful.
Yeah, because you got to remember that not every advisor is getting paid, as a fiduciary that's, well, let's just say some are fee based, right? Which most of them are fiduciaries, and then some are commission based.
And when you're selling a property, you're not just selling it for the rent. You're selling it for the increase in the property price. Dave and I represented a family that had a rental property that was right next to a yacht club in an exclusive area of California. And
let's just say it was a good purchase that this guy did, 20 years before that?
Yeah, they rented this place to a body shop. Now, the body shop's not going to be able to afford more than $20,000 a month in rent. But the property was worth multi-millions. And eventually somebody did buy that piece of property and they built a high rise on it. Because it overlooks, with the condos overlooking the yacht club in a beautiful area. But you have to sometimes just keep $20,000 a month in rent, even though you could maybe make a whole lot more, while the fair market value of that property is climbing, and then you sell it at the right time, and you get the best of both worlds.
In that case, the lease doesn't matter what it says. It's all about the value of the land.
That's right.
Yeah, no, that's really good. We'll end on this one, but what advice would you give a business owner that's contemplating a sale that also owns the real estate?
Yeah, I think Dave and I would always say, hey, consider keeping it. If you're going to sell to a PE group, which is who we normally sell businesses to, we sell to individuals as well, but PE groups don't necessarily want the real estate. Cut a deal on the lease, and it's great passive income in retirement or in just to keep for, like Dave and I said, we have done on a couple of properties. And so, the price of real estate generally will go up. Protect yourself inside of an entity so you don't get hit with EPA stuff, but it's a great investment.
Yeah, that's great. All right. Well, thank you everyone for tuning in, and we'll see y'all next time.
And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.